Ladies and gentlemen, have you noticed something strange happening in our economy? While the rest of the world's markets hold steady, right here at home, prices are tumbling. It's not just a coincidence, it's a signal that our system, in some ways, is rigged, and that forces both visible and hidden are shaping the very fabric of our financial reality. But here's the thing, knowledge is power, and understanding this imbalance is the first step toward reclaiming control. In a development that has sent ripples across financial circles, the United States is witnessing a dramatic decline in domestic prices while markets across the globe remain remarkably stable. It is a stark and unusual divergence that has left economists and policymakers alike searching for explanations. Consumers are experiencing a noticeable drop in the cost of everyday goods, from groceries to electronics. Yet when they glance at global indices or international commodity markets, prices are holding steady, sometimes even climbing. This discrepancy raises immediate questions. Why is the US market seemingly diverging from global trends, and what does it mean for the average household and investors and the broader economy? Some experts describe the phenomenon as a controlled shock, hinting at forces, economic, political, and strategic, that are orchestrating these shifts behind the scenes. What makes this scenario particularly striking is a contrast between perception and reality. On the surface, falling prices may appear as a relief, suggesting increased affordability and consumer advantage. Yet, beneath that apparent benefit lies a complex web of signals indicating potential instability. Rapid price declines can erode business profits, disrupt supply chains, and even trigger shifts in investor confidence. For a nation whose economic narrative often emphasizes strength and stability, such a divergence can feel disorienting. International observers have noted that while inflationary pressures and supply constraints continue to influence global markets, the US is experiencing an almost inverse effect, highlighting an unusual decoupling from international trends. Adding to the intrigue is the speed at which these changes are unfolding. Markets do not typically move in isolation. They are interconnected, reacting to trade flows, global demand, and geopolitical developments. Yet the US price collapse appears disproportionately sharp, suggesting that domestic factors, ranging from fiscal policies to interest rate adjustments, may be interacting with global pressures in unexpected ways. Economists point to subtle signals of intervention or market recalibration, warning that while the immediate effects may seem beneficial for consumers, the long-term implications for the economy are far more complex. Amid this turbulence, attention is increasingly focused on the underlying mechanics of pricing, currency flows, and policy decisions that could be amplifying these effects. Financial analysts, traders, and policymakers are closely monitoring the situation, aware that what may appear as a temporary anomaly could evolve into a more systemic trend with far-reaching consequences. This divergence is not merely an economic curiosity, it is a signal that the rules of the game may be shifting, requiring both vigilance and strategic adaptation from every stakeholder in the market. The US price crash, set against the backdrop of stable global markets, is a phenomenon that commands attention and demands careful analysis, as its impact resonates well beyond the boundaries of The unfolding economic scenario has sparked intense scrutiny, as analysts explore the possibility of a coordinated shift influencing the US market, suggesting that recent price movements may not be purely organic. Observers are pointing to patterns that hint at deliberate interventions, raising the specter of a complex interplay between government policy, central banking decisions, and strategic maneuvers by major market players. While sudden price fluctuations are a familiar feature of markets, the magnitude and timing of the US price collapse, occurring while international prices remain stable, suggests forces at work that extend beyond conventional supply and demand dynamics. Some experts argue that this is less a spontaneous market correction and more a carefully orchestrated adjustment, a scenario where timing, policy alignment, and strategic positioning converge to produce a specific outcome. What makes this possibility particularly compelling is the precision with which these shifts have occurred. In an interconnected global economy, markets rarely move in isolation, yet the US appears to be following a trajectory that diverges sharply from global trends, almost as if guided by a coordinated hand. Central banks, fiscal authorities, and large institutional investors wield tremendous influence over market expectations, and even subtle policy signals can ripple through pricing structures in ways that magnify their impact. Economists highlight that such interventions, whether intentional or emergent from aligned strategies, can create artificial signals that influence behavior across multiple sectors, from commodities to equities, shaping market perception before tangible economic indicators fully reflect the changes. Adding another layer of complexity is the international dimension. While US prices are dropping, global indices remain resilient, demonstrating that this is not simply a reaction to global economic pressures. Analysts suggest that synchronized policy measures and strategic positioning by large financial entities could be generating an artificial disconnect between domestic and international price trajectories. This raises critical questions about transparency, fairness, and market stability, prompting calls for closer examination of the forces behind the scenes. The implications of such coordinated movements are profound. Investors, businesses, and everyday consumers may find themselves navigating an environment where standard market logic is temporarily suspended, where prices no longer reflect underlying supply and demand, but instead the influence of orchestrated forces. Understanding these dynamics requires more than surface-level observation. It demands careful analysis of policy shifts, financial maneuvers, and the timing of market responses. For those who pay attention, the coordinated nature of the changes offers insight into strategy and opportunity and potential risks that could define financial outcomes in the months and years ahead. This phenomenon challenges conventional assumptions about market behavior, revealing a layer of complexity that few are prepared to fully navigate, yet all are compelled to acknowledge. Amid the turbulence of falling U.S. prices, there emerges a compelling opportunity that many are overlooking, one that lies at the intersection of strategy, foresight, and decisive action. While headlines focus on the shock of rapid price drops, a closer look reveals that these moments of disruption are fertile ground for those prepared to navigate uncertainty. Markets, by nature, are cyclical, and history demonstrates repeatedly that periods of instability often precede phases of growth for those who act strategically. Savvy investors, innovative businesses, and forward-thinking individuals recognize that every downturn carries with it the seeds of opportunity waiting to be nurtured by careful analysis and informed decision-making. The current U.S. price collapse, juxtaposed against steady global markets, is precisely the kind of moment that separates reactive participants from proactive leaders. What makes this period particularly intriguing is the contrast between perception and potential. Many may view falling prices as a warning and a sign that the economy is faltering, and yet for the prepared, it signals openings for smart investment and calculated risk-taking. Entrepreneurs can leverage lower costs to restructure operations, invest in new technologies, or expand product offerings at reduced overheads. Investors can capitalize on undervalued assets, identifying sectors temporarily mispriced by the shock and positioning themselves ahead of the eventual recovery. Even consumers, by making strategic choices, can lock in value and build financial resilience, transforming what appears to be a moment of loss into long-term advantage. The speed and scale of the U.S. price decline only intensify the urgency for action. Timing, as always, is critical. The window to seize advantage in such periods is narrow, and hesitation can result in missed opportunities. Analysts emphasize that those who monitor trends closely, understand underlying economic signals, and act decisively can turn volatility into a platform for growth. This requires a shift in mindset, from fearing the disruption to embracing it as a signal to innovate, adapt, and move confidently in areas others may avoid out of caution. Moreover, the divergence between domestic and global markets creates unique leverage points. While the U.S. experiences rapid deflation, international prices remain steady, offering opportunities for strategic trade, investment, and positioning that capitalize on the gap. This is not merely about financial gain. It is about cultivating adaptability, foresight, and resilience in an environment that rewards those prepared to navigate complexity. In this sense, the current economic scenario is a clarion call for action, a reminder that opportunity often arrives disguised as challenge, and that those willing to see beyond the immediate disruption can emerge stronger, more agile, and better positioned for long-term success. The recent U.S. price collapse has cast a sharp spotlight on structural vulnerabilities within the domestic economy, revealing weaknesses that were long overlooked. While falling prices may appear beneficial to consumers in the short term, the deeper implications point to systemic challenges that could shape economic performance for years to come. Unlike gradual shifts caused by natural market cycles, the rapidity and scale of the decline suggests that domestic systems, ranging from supply chains to regulatory frameworks, are highly sensitive to sudden shocks. Experts warn that this is not simply a temporary correction, but a signal that existing mechanisms for stabilizing prices and ensuring market equilibrium may be insufficient under current conditions. What makes this observation particularly concerning is the contrast with global markets. Around the world, prices remain relatively stable despite inflationary pressures, supply chain disruptions, and geopolitical uncertainty. This divergence underscores that the problem is not driven solely by external forces, but is deeply rooted in the structure and functioning of the U.S. economy. Analysts highlight that domestic production costs, labor market dynamics, and monetary policies are interacting in ways that amplify volatility rather than dampen it. For instance, price drops in critical sectors may erode profit margins for businesses, forcing cutbacks that could ripple through employment, investment, and consumer confidence. This cycle creates a feedback loop where structural fragility intensifies market instability. Adding to the complexity is the interconnectedness of sectors within the U.S. economy. A disruption in one segment, whether energy, agriculture, or manufacturing, can cascade rapidly, producing disproportionate effects on pricing and consumption patterns. Observers note that modern markets are highly sensitive to signals from policy and investor sentiment, and small shifts can trigger outsized reactions when underlying systems lack resilience. The current price collapse exemplifies how systemic weaknesses, once latent, can become fully visible when subjected to stress, highlighting the need for both vigilance and strategic adjustment. Moreover, these vulnerabilities have implications that go beyond economics alone, affecting public confidence, investment behavior, and international perception of the U.S. market. Investors are increasingly cautious, recalibrating portfolios in response to volatility, while businesses must rethink supply chains and operational models to survive periods of rapid change. For citizens, the fluctuation in prices challenges traditional assumptions about stability, emphasizing the need for financial literacy, planning, and adaptability. What may have once been considered routine market behavior now appears as a critical test of structural resilience, revealing that the stability of an economy is not guaranteed but must be actively maintained, monitored, and strengthened. As U.S. prices continue to decline while global markets remain steady, the urgent need for awareness and proactive action has never been clearer. The current economic turbulence is more than a statistical anomaly. It is a warning signal, a call for individuals, businesses, and investors to assess their positions, reevaluate strategies, and prepare for a landscape that is increasingly unpredictable. Those who assume that traditional market logic will continue to apply risk to being caught off guard, while those who remain vigilant can leverage this period to strengthen resilience, capitalize on emerging opportunities, and gain an advantage over less prepared competitors. Every fluctuation, every unexpected shift carries with it information that, if interpreted correctly, can inform smarter, more strategic decision-making. One of the most compelling aspects of this situation is the role of knowledge as power. The disparity between domestic and global prices is a complex phenomenon that requires careful observation, understanding of underlying trends, and interpretation of signals that are often subtle. Policy shifts, interest rate adjustments, supply chain developments, and international market dynamics all converge to shape the domestic price environment, making it imperative for stakeholders to remain attentive. Consumers, for instance, can make informed purchasing and investment choices by understanding which sectors are most affected by the drop and where value is genuinely being created. Businesses can reassess supply chains, inventory management, and pricing strategies to maintain profitability despite volatile conditions. Investors can identify undervalued assets in sectors with growth potential before broader market corrections occur. The speed and unpredictability of these changes mean that delay or inaction can be costly. Analysts emphasize that those who monitor trends closely, who interpret signals from multiple angles, and who act decisively are often the ones who emerge ahead in periods of disruption. This is not merely about survival, it is about positioning oneself strategically in a landscape where others may be. Paralyzed by uncertainty, awareness must translate into action, and action must be guided by insight, discipline, and forward-thinking strategy. The broader lesson is that the current market conditions highlight the interconnectedness of decisions at all levels. Individual choices, corporate strategies, and policy initiatives interact in ways that can magnify both risk and opportunity. By cultivating awareness, remaining informed, and responding decisively, stakeholders can transform turbulence into a competitive advantage. The U.S. price divergence is more than a challenge. It is a real-time lesson in vigilance, strategic thinking, and the importance of being prepared when the rules of the market seem to shift unexpectedly. Amid the turbulence of the U.S. price collapse and the stark contrast with stable global markets, one theme emerges more clearly than any other. Resilience is the currency of long-term success. In a market that feels unpredictable and even rigged at times, It is those who adapt, innovate, and maintain a strategic mindset who thrive, while the unprepared are left struggling to catch up. Resilience does not mean passive endurance. It is active engagement, the ability to analyze shifts, anticipate challenges, and respond with both agility and foresight in an environment where prices can drop sharply and seemingly without warning. This ability becomes not just advantageous but essential. What makes resilience particularly critical is the scale and speed of the disruption. The domestic market is moving rapidly, and the forces behind the price decline are complex and interconnected. Investors who cling to traditional assumptions about stability may find themselves exposed, while those who cultivate adaptability can seize opportunities even amid uncertainty. Businesses that quickly reorient their strategies, rethink supply chains, or diversify revenue streams and position themselves to benefit from shifts that might otherwise seem purely threatening. Consumers, too, can build personal financial resilience, making choices that protect and even grow their value in a market that rewards awareness and strategic foresight. The current scenario also underscores the importance of perspective. While it is tempting to view falling prices as a purely negative phenomenon, resilient participants recognize that volatility carries opportunity. Those who embrace challenges as catalysts for innovation, who analyze disruption rather than fear it, and who act decisively often emerge stronger, better positioned, and more informed than those who wait for stability to return. The ability to navigate a perceived rigged system requires not just awareness of external forces, but confidence in one's own strategies, flexibility in approach, and discipline in execution. Furthermore, resilience is amplified by preparation and insight. Understanding market mechanics, monitoring policy changes, and observing global trends allow individuals and organizations to anticipate shocks rather than simply react to them. This proactive approach transforms potential vulnerability into strategic advantage. History has repeatedly demonstrated that moments of crisis are also moments of innovation, leadership, and breakthrough. Those who internalize the lessons embedded in these disruptions, who remain vigilant, informed, and decisive, become architects of their own success rather than passive participants in a volatile system. In this environment, resilience is both a mindset and a strategy. It is the willingness to adapt, the foresight to act ahead of others, and the courage to transform uncertainty into opportunity. While markets may fluctuate and systems may appear unbalanced, those who cultivate resilience are able to navigate complexity, leverage opportunity, and build outcomes that are not dictated by circumstance, but shaped by informed, decisive, and confident action. So, I urge you all, do not despair at the rigged nature of these events. Instead, let it ignite your determination. Let it push you to ask the hard questions, to explore solutions, and to stand resilient. Every time the system seems to falter, it gives those prepared the chance to rise, to lead, and to transform adversity into triumph. This is our moment to not just witness change, but to be the architects of it. In closing, remember this: the world may have its plans, and the markets may seem unfair, but your vision, your courage, and your action are unassailable. Stay informed, stay bold, and turn this moment of economic turbulence into a launching pad for your success. Together, we can rise above the chaos, navigate the rigged systems, and build a future defined not by market crashes, but by human creativity, resilience, and unstoppable ambition.